St. Vincent's. So I'll be taking you through today's tax update. So we'll get straight into it because we've got quite a bit of content to cover today. So to begin with, I'll just give you a brief overview of what we'll be going through. So this session will be looking at a few different topics, which we have grouped into 4 different categories as follows. So the first of these is an update on recent cases that have gone through the court system. Secondly, we'll be looking at recent legislation updates and tax rulings. Then we'll look at some interesting private binding rulings before finishing up with some current ATO focus areas and audit activity and other ATO related updates. Okay, so the first case that we're going to be looking at today centered on a company's eligibility for the cash flow boost subsidy. So in this case, we had a company, MJ and IT Holdings Pty Ltd, which operated as a business. The company made payments totaling approximately $28,000 to one of its directors between 1 July 2019 and the 30th of March 2020. These payments were all recorded in the accounts of the company as a debit to the director's loan account, which in most instances was narrated as being a loan to the director, but there were some instances where these entries were narrated as director's drawings. So an accounting entry was created in late March 2020 to recognize a $25,000 director's fee. The way this was processed was by taking up a wages expense in the P&L, profit and loss, with a corresponding liability being recognized in the wages payable account in the balance sheet. So standard entry for wages being paid. A payslip was then generated through the company's payroll system, the single touch payroll system. A subsequent journal entry was then processed and narrated as being a payment, critical term there, of wages to the director, with the entry being recorded as a debit to the wages payable, so that liability is now gone down, and a credit to the director's loan account. The key issues considered by the courts in determining this case was whether the accounting entries constituted constructive payment and whether the accounting entries had the sole or dominant purpose of increasing the company's eligibility for cash flow boost subsidy. So this slide just briefly shows how those transactions that I just went through were recorded and the impact that those transactions had on each account. So all the accounting nerds that are listening in, this will be a nice straightforward entry for you. So you can see here that if you consolidate entries 2 and 3 into a single entry, then the transaction was effectively a $25K wages expense and a corresponding $25K liability owing to the director. So essentially this wages payable was in and out. So the key issues considered by the courts in determining this case, as I mentioned, was whether there were the accounting entries that were taken up, as we're shown on the screen here, constituted constructive payment, and whether the accounting entries had the sole or dominant purpose of increasing the company's eligibility for the cash flow boost subsidy. So the decision here, so the courts found that the constructive payment had in fact occurred. This was on the basis that even though the $25,000 gross wage, that's before any tax withheld, had not been physically paid to the director had, in their capacity as a director, as well as in their personal capacity, essentially agreed that the company would record the wage and report the pay and the required pay-as-you-go withholding to the ATO in their BAS, and also through the single touch payroll system. Additionally, as the wage had been expensed in the accounts, the courts found that this was sufficient evidence to create an employer superannuation guarantee obligation for the company, which meant that the company was required to pay super. However, the courts determined that the company was actually ineligible to receive the cash flow boost subsidy due to non-compliance with the integrity provisions of the Cash Flow Boost Act. The reasons for this were that the parties were not dealing on an arm's length basis, and the only reasonable conclusion for the taxpayer fixing the remuneration in March, so taking up that journal entry for the wages, rather than, say, adjusting for this when the annual accounts were prepared sometime after the end of the financial year, was solely to enable the company to claim the cash flow boost. It's interesting because this is actually the first case that the Commissioner has raised the integrity provisions of the Cash Flow Boost Act. So I'm sure we'll see plenty more of activity in this area now that this case has gone through. Okay, so the next case that we're looking at is Egroup Security, so Payroll Tax and Employment Agency case. So in this case, Egroup Security was the main operating and parent company in a group of companies across Australia. In operating its business, Egroup would enter into contracts with third parties for the supply of contracted security guards. So they were essentially outsourcing from other organisations. So the company would then use these contractors to provide security services to their clients. The payroll functions for these contracted services were performed by subsidiaries of the main parent company, Egroup, and these were taken up in the various subsidiary companies based on the location of the security guard across Australia. So if a security guard was working in New South Wales, for example, then the subsidiary that dealt with New South Wales security guards would be responsible for looking after the payroll for that security guard. So the issue that the courts were looking at here is whether or not the arrangements between the parent company, Egroup Security, and its clients were employment agency contracts under the New South Wales Payroll Tax Act. There was also an alternative second issue that was considered, which was whether the arrangements between Egroup Security, again the parent company, and its wholly owned subsidiaries were employment agency contracts for New South Wales payroll tax purposes. The argument raised here was that the subsidiaries were doing more than providing payroll functions, and that they were actually involved in procuring the security guards on behalf of the parent company. If this argument had held up, then each subsidiary would have been an employment agent and the client would have been Egroup, the parent company. So in a win for the taxpayer, it was actually found that the arrangements by which the parent company provided security services to its clients did not constitute an employment agency contract. The alternative argument that contracts between Egroup Security and its subsidiaries were employment agency contracts was also rejected. So the reasons for these decisions were many, and included the fact that the security guards were predominantly working at the ultimate client's premises. The client was able to give some direction and instruction to the security guards, and the security guards were generally not allowed to access the client's staff facilities. So as a result, the payroll tax assessments were revoked. Okay, so this next case, we are looking at an elderly couple. So Eddie and Mabel were aged 87 and 77 and were married with 2 sons and owned all of the lots in a strata plan at Maroubra, I'm not sure if I'm pronouncing that correctly, in various ownership combinations. So they had a number of units. Unit 8 and Unit 10 specifically are the ones that were considered in detail in this case. So Unit 8 and Unit 10 were located adjacent to each other and were actually only about 3 meters apart from each other, so right next to each other. The land tax assessments were issued to all family members, so including the children, for the 2020 land tax year, and to Eddie for 2016 to 2019 as well by the New South Wales Commissioner. So one of the really critical things in this case was evidence as to whether or not Eddie and Mabel had in fact separated. And the courts found that there was a few inconsistencies in the documents as to whether they were still living together and which property or unit specifically was actually the principal place of residence for each of them. So in terms of the records, Unit 8 was listed as Eddie and Mabel's address on the electoral roll. However, the tax returns, for example, created inconsistencies as it showed that they were still listed as each other's spouses, so still together even though they said that they had separated, and they had both recorded Unit 10 as their residential address in the tax return. They also shared private health insurance, a joint bank account, and other common details that you would expect of a couple that were still essentially together. Eddie had also listed Unit 10 on his driver's license, despite maintaining that his residence was actually Unit 8 for the purposes of the land tax exemption. As a further inconsistency, when the strata plan for the property was registered in 2019, Eddie and Mabel were registered as joint tenants for lots 6 and 7. So remember I said at the beginning, we've got a few lots in the strata title that was owned by the family. So continuing on, Eddie and Mabel each sought to claim the principal place of residence exemption for Unit 8 and Unit 10 on the basis that they had lived separately and had been estranged for several years. So under the principal place of residence exemption in the New South Wales Land Tax Act, there can only be one principal place of residence for members of the same family, which includes spouses. However, the Commissioner does have a discretion to choose not to regard married people as spouses if he is satisfied that the spouses do not in fact live together and have no intention of living together in the future. Despite Eddie providing a statutory declaration to the court stating that he resided on his own at Unit 10 and had been estranged from his wife for 5 years, as well as Mabel providing an affidavit that she had resided on her own at Unit 8 and did not see any notion of reconciliation with her husband in the near future, the courts found that there was insufficient evidence to prove that they were not living together. So unfortunately, as a result, the principal place of residence exemption was not available for land tax purposes for either of them. So Eddie also tried to argue that the assessments issued to him were harsh, unconscionable, unfair, and inequitable for the 2016 to the 2019 year and should be set aside. This was also denied as there was no dispute that the assessments were validly issued, so the tribunal did not have the grounds to determine this. Okay, just a quick update on some appeals for anyone who is familiar with these cases. So in the case of Craig Doyle, he has discontinued his appeal. This case was looking at whether the proceeds from the sale of undeveloped industrial land were income and not capital in nature, as the sales were part of Doyle's ordinary course of business. And the other one, Joubert, I think I'm saying that right, he's also discontinued his appeal. So the AAT held that an Australian citizen working in Singapore was an Australian tax resident according to the ordinary concepts test. Okay, quick update on legislation progress. So these names probably don't mean much to anyone. So just quickly, the last month we've had 2 bills that were passed through the Senate and became law. So the first of these is this Treasury Laws Amendment number 2 here, which became law on 13th of September. And it included an amendment to require a fund, authority, or institution as a precondition for deductible gift recipient status, which, if you're familiar with that term, it's required in order to get a deduction essentially for a donation made to such an entity, requires that the entity must be operated by either a registered charity or an Australian government industry. While this requirement already applied to the majority of deductible gift recipient categories, the amendments extend this requirement to the remaining 11 DGR categories. And the second one we're just going to touch on briefly is this last one here. So number 7 was introduced to the Senate, which includes a proposed amendment to the Fringe Benefits Tax and Income Tax Assessment Acts to remove the $250 non-deductible threshold for work-related self-education expenses. So moving on now to some COVID-19 updates. So we're just going to go through a few updates on a state-by-state basis here. Oops, sorry. So firstly, we've got New South Wales. So the New South Wales government is funding an expansion of the JobSaver program, despite the Commonwealth government previously announcing it would cease payments from 10 October 2021. So JobSaver is now being gradually phased out until 30th of November when payments will cease. For Victoria, it was announced on the 30th of September that businesses receiving Business Cost Assistance Program payments and licensed hospitality venue fund payments would receive further top-up payments. These payments will be made automatically on a fortnightly basis to businesses already registered for these support programs and do not need to be applied for. The phasing out of these payments is said to be in line with achieving the 70% and 80% vaccination rates. Therefore, the dates might actually change because at the moment, I suppose it's a little bit unsure if we'll actually meet those targets. So for Queensland, in September, the Commonwealth and Queensland Government announced a joint emergency support package for businesses suffering due to border restrictions and also to provide targeted support to tourism and hospitality businesses. Recipients of the COVID-19 business support grants who are located in the border zone will also now receive a one-off hardship scheme grant of $5,000 for employing businesses and $1,000 for non-employing sole traders. Applications are now open for this grant. And in addition, the tourism and hospitality sector hardship program applications open on Monday, the 11th of October, and will close on Monday, the 22nd of November. So under this program, eligible businesses can apply to receive funding totaling $30,000, $50,000 or $100,000 depending on their payroll size, which will be paid via 2 installments. Okay, so the ACT government is providing an additional one-off $200 increase in the utilities concession, which now brings the total up to $1,000 for the 2022 financial year. Eligible applicants include those who hold a Centrelink pensioner concession card or low-income healthcare card, or a Veterans Affairs pensioners concession or gold card. It's quite a mouthful. So in addition, the commercial landlords who offer rent relief through to 31 December 2021 may be eligible for a commercial rates credit of up to $10,000. And this one was previously limited to $5,000. Residential landlords providing rent relief to tenants are eligible for a credit on their land tax of up to $100 per week, which has been extended out to 31 December 2021. And finally, Tasmania. So the Tasmanian government is providing additional grants to eligible businesses based on turnover with 2 funding rounds. Businesses that have already been deemed eligible for support through the initial support package will receive the next payment in line with the new maximum grant amounts. So the first round of funding closed on the 8th of October, and applicants will be notified in November when the next round is open and what further evidence will need to be provided. There is also payroll tax relief available for tourism hospitality businesses where there has been a 30% reduction in turnover in the September 2021 quarter. Okay, this one's just a really brief update on a games and sporting exemption ruling. So it's a taxation ruling 2021/D6, which replaced the former ruling 97/22. It does not reflect a change in the view adopted in the previous ruling, but it gives a more contemporary expression and takes into account relevant case law. So general requirements are that the society, association or sporting club is established for the main purpose of the encouragement of a game or sport and is not carried on for the purpose of its members' profit or gain. And there's also some other special conditions that need to be met, but that wasn't specified in this ruling. All right, so some more updates. This time we're looking at private binding rulings. So the first of these rulings involved a publicly listed company, parent company, and its 100% owned Australian subsidiary company. The subsidiary company conducted the business operations in Australia for the parent company, and it also acted as the employer for all Australian residents in the group. So the parent company charged license fees to the subsidiary, and it also on-charged administration costs, including accounting fees, audit fees, professional advice costs it had incurred, etc., on which there was no markup percentage charged to the subsidiary. I'll just jump forward one for a moment so we can see the diagram here. For those of you that like to look at a picture, I'd certainly like to look at diagrams to make sense of these cases. So to facilitate an employee share scheme, the parent company set up an employee share trust. So you can see that's this entity over here. The parent company made contributions to the trust, with the trust then using these funds in turn to subscribe for shares in the parent company. The parent company on-charged the contributions as well as setup costs and ongoing entity costs of the trust to the subsidiary without any markup having been applied. So it was consistent with the approach they adopted for other costs incurred. So the ruling considered two principal issues. Firstly, whether the setup costs and establishment costs as well as the ongoing costs of the employee share trust were deductible at the parent company level. And secondly, whether the reimbursement of these costs to the parent company constituted assessable income for the parent company. So did we have a deduction and did we have assessable income? As to whether the employee share trust costs were deductible, the ATO found that the costs were not deductible to the parent company under the ordinary deductibility provisions, and found that they were also not deductible under what we call the black hole expenditure, which is a bit of a catch-all or last resort provision, and further also not deductible under the cost of managing tax affairs provisions. This is on the basis that the costs were not sufficiently connected with or incidental to the income earning activities of the parent company. The ATO also found that the reimbursements received by the parent company from the subsidiary were not assessable income, as these receipts were not income according to ordinary concepts. So we've got money coming in from the subsidiary as a reimbursement, and we've got expenses going out in relation to the employee share trust, but for the company, the ATO is saying not assessable and non-deductible. So importantly, the ATO noted that an amount is not automatically income simply because it represents the recovery of deductible expenses. So just as an aside, as you said here, there's no tax, I suppose, to pay in the parent company, no assessable income, no deductible expenses, but the ATO was principally concerned with what happened at the parent company level. So for the subsidiary, which was on charge, those setup costs, etc., because that was in the ordinary course of the subsidiary's business activities, the ATO noted that those expenses would still be deductible in the hands of the subsidiary. Okay, our favorite topic, Division 7A loans. I'm sure a few people are probably having a bit of a negative reaction. That's one of those areas that we often have a bit of a physical reaction to. So Division 7A loans. So this private binding ruling considered whether the Division 7A deemed dividend provisions would apply to a payment made by a private company to its shareholders. So this case involved a husband and wife, Mr. and Mrs. A, who were both shareholders and directors of Company Y and shareholders of Company X. Mr. A was also the sole director of Company X. So just a quick diagram here again. So under a loan agreement between the two companies, Company Y loaned funds to Company X, despite the fact that Company X did not appear to have the capacity to repay this loan to Company Y. Now, the amount noted on the slide here, the $250,000, is not actually the exact amount, but for the purposes of demonstrating how the money flowed, I've set the amount to be the same. So Company X used the funds that it received from Company Y to repay the loan owing to Mr. and Mrs. A. Importantly, the amount loaned by Company Y was equal to the amount owing by Company X to Mr. and Mrs. A. So $250K has gone from Company Y to Company X and then out to the individuals. So the issues in this ruling was whether the payment from Company X to Mr. and Mrs. A would be deemed to be a dividend. The ATO noted that as Company X was essentially an interposed entity between Company Y and Mr. and Mrs. A, Section 109T needed to be considered. So this section of the Act operates in such a way that at face value, the sole or main purpose of the loan having been made to Company X was to enable a payment or loan to be made to Mr. and Mrs. A, or the target entity. On this basis, the loan from Company Y to Company X may be regarded as a loan or payment from Company Y to Mr. and Mrs. A. So, I think I've got my slides over here. Sorry, go back a step. So the Ato Determination. So the Ato found that payments that are made to discharge an obligation are not treated as dividends. The Ato therefore accepted that the payment from Company X to Mr. and Mrs. A was in fact a genuine repayment to Mr. and Mrs. A in order to discharge the company's debt, and that the amount of any deemed dividend or deemed payment to Mr. and Mrs. A was actually nil. As a final point to note, when you consider the facts of the case, the transaction essentially represented a refinancing of the debt for Company X, as the company's net debt remained the same. So just returning back to that diagram briefly. So originally the company owed $250,000 to Mr. and Mrs. A. After the transfer of funds, then that loan was then owing to Company Y instead. All right, so this next case was looking at the vesting of a trust and cost-based issues. So I'll just briefly go through this one. There wasn't too much to consider in this case. So there was a trust that held pre-CGT shares. So pre-CGT shares, the critical date here is that they existed and they were held before the 20th of September 1985. So the trustee appointed person X as primary and sole beneficiary of the trust. The trust was then vested, and the trustee transferred the trust fund, including the shares, to person X for no consideration. So the issue here was, what was the first element of the cost base? So we're talking about CGT here, or reduced cost base of the shares immediately after vesting of the trust. So the ATO found that CGT event E5 occurred on vesting of the trust because the beneficiary, person X, became absolutely entitled to the shares, which are CGT assets. As no consideration was paid for these CGT assets by the beneficiary, the market valuation substitution rules apply to deem the first element of the cost base of the shares to be the market value as at the time of vesting of the trust. So that one's a pretty straightforward outcome there. Okay, so this last private binding ruling we are looking at today dealt with the CGT implications of a relationship breakdown. So the facts were as follows. A and B were in a de facto relationship and were equal shareholders in Company C, with A being the sole director of the company. The company had retained earnings and consequently they had franking credits available. So A and B separated and they decided that their shares in the original company, Company C, will be transferred out to two new companies, Company A and Company B, so 50-50. It was proposed that a dividend would then be paid by the original company to the new companies, A and B, and the original company would then be wound up. So from a CGT rollover perspective, A and B essentially disposed of their shares in the original company, and in return, they received their shares in their respective new companies. So the issues here were firstly that whether or not the CGT rollover was available to both A and B on transfer of their respective shares to their new wholly owned companies. And secondly, if the original company had paid the proposed dividend to the two new companies, would the ATO regard this as a franking credit benefit scheme under the anti-avoidance provision? So in a really high-level summary, essentially was the payment of the dividend to obtain a tax benefit for A and B. So the rollover was, as a transfer of the shares, was made by an individual to a company, and all of the requirements in the rollover were met. The ATO was satisfied that the rollover was available to both A and B. As a result, no CGT was payable, on the transfer of the shares to their respective new companies. As to the question as to whether or not there was a franking benefits scheme, given that the transfer of shares resulted from a relationship breakdown and a genuine one, and A and B remained the ultimate economic beneficiaries of the franking credits. So, before the company was out up and they went their separate ways, they were both shareholders in the original company, and then after their separation, they were equally shareholders in their own companies. So ultimately, they each still had a claim. The ATO was satisfied that the share transfer was not undertaken for the purposes of obtaining a tax benefit. All right, so this is a bit of an interesting area now that we're going to be looking at, which is talking about gifts and loans from related overseas parties. So with the advancements in technology in recent years, the ATO's data matching powers have increased exponentially. And despite this, some taxpayers continue to try and disguise foreign income by arranging for it to be transferred by related parties overseas to Australia and claiming these transactions are gifts, in inverted commas, rather than accessible foreign source income. So the ATO is also aware that some taxpayers are treating the transfers as being loans from foreign-related entities for which they are then claiming interest deduction, despite having never actually incurred any interest. So to try and combat this, the ATO have released a Taxpayer Alert, which outlines 3 examples of arrangements that may attract the ATO's attention under the tax avoidance and evasion provisions. The ATO has also confirmed that they are actively expanding audit resources to identify taxpayers who may be operating these types of arrangements. As always, the ATO is encouraging any offending taxpayers to be proactive through early engagement with the ATO to amend their tax returns and make voluntary disclosures, as doing so will reduce any penalties that may apply. So for anyone who's sitting there worrying about whether or not they may be on the ATO's radar, there is such a thing as a genuine gift or loan. So don't be too alarmed. The ATO are aware that some transactions are genuine and are not part of an arrangement to conceal foreign income. And to this end, the ATO have released a guidance as to what may be regarded as a genuine gift or loan from overseas related parties. And like many things to do with the ATO, one of the overarching themes here is that there needs to be appropriate supporting documentation. So just briefly, the ATO consider that a genuine gift or loan is one where you've got appropriate documents, the party's behaviour is consistent with that characterisation as a gift or a loan, and the monies provided are sourced from funds that are genuinely independent from the taxpayer in Australia. So where genuine gifts such as an inheritance are used to fund a taxpayer's business or to acquire income-producing assets, the ATO expects to see supporting documentation, and this means that there needs to be contemporaneous declarations that the donor has made in their country of residence about the nature of the amounts transferred. There needs to be a deed of gift prepared by the donor, although this may not necessarily prove that there has actually been a genuine gift. And there needs to be formal identification of the donor, certified copy of the donor's will, and a few other documents and bits and pieces. So you can see here that there's quite a bit of evidence that needs to be available should the ATO look into this. So where a genuine loan is used to fund a taxpayer's business or to acquire income-producing assets, the ATO also expects to see a properly documented loan agreement. And sometimes, I guess with many loan agreements, you expect to see security provided over the loan, and the declarations need to be made in a sort of a lender-borrower terms. As we're dealing with foreign overseas entities, the ATO also expects that if there's any interest to pay, that payment of withholding tax will apply, and that there is a capacity to actually repay the loan, so it is a genuine loan. Okay, so the next one is New South Wales payroll tax and employer super contributions. So a new practice note has been published which confirms that employer super contributions made for the benefit of an employee, including members of the board and directors, are treated as wages for New South Wales payroll tax purposes. The practice note also considers underpaid wages and confirms that payroll tax is payable in the financial year in which wages should have been paid, even if they haven't been paid. So noting for superannuation guarantee purposes that under the Payroll Tax Act, the obligation to make super contributions on the unpaid wages doesn't actually arise until the wage is paid. So what this means is that you may have a wage that's included in one payroll tax year, but the corresponding super is not included until the subsequent payroll tax year when the wage is actually paid. So where compensation is paid by the employer to an employee for the late payment of their wages and superannuation, these compensation amounts are not actually included in the definition of wages for New South Wales payroll tax purposes. Okay, so Legal Professional Privilege Protocol, LPP. So last month, the ATO released a draft Legal Professional Privilege Protocol. For those of you that are maybe not familiar with this concept of legal professional privilege, it essentially serves to protect the confidentiality of certain communications made in connection with giving or obtaining legal advice from a lawyer. From a tax perspective, it's often relied upon where available in determining what records must be provided and surrendered to the ATO under the ATO's information gathering powers, particularly in the event of an audit or other ATO investigation. So the draft LPP protocol covers the ATO's recommended approach for identifying what documents and communications may be covered by legal professional privilege. The protocol sets out a three-step process which needs to be carefully considered and followed by any party seeking to claim legal professional privilege. The ATO has also issued this protocol in response to several concerns they have around legal professional privilege, including whether there's any arrangements whereby advice is being deliberately routed through a lawyer merely to enable legal professional privilege to be claimed and or to conceal evidence, and also whether any legal arrangements are entered into after the advice has actually already been given, again on the guise of creating some kind of legal professional privilege. All right, so JobKeeper update now. So the Inspector General of Taxation and Taxation Ombudsman, quite a mouthful, recently published a report that looked at the ATO's handling of JobKeeper enrolment deferral requests received. The report found that such deferrals may be granted by the ATO where it is fair and reasonable to do so. However, the ATO actually failed to apply this threshold test when considering whether to grant JobKeeper enrolment deferrals to applicants. Instead, the ATO overwhelmingly granted deferrals where they were satisfied that there were exceptional circumstances that were covered by one of four very limited reasons. Further, the report found that the ATO failed to consider the unique facts and circumstances of each case. So since April 2021, the ATO have now revisited and overturned a number of these decisions and have since found in favour of the taxpayer. That's some good news there. So revenue for New South Wales. So there's been a new practice note guidelines that have been issued regarding employment agency contracts and the key elements that give rise to such contracts. So just included this one here because it does tie back to the case that I went through earlier around employment agency contracts. And this practice guideline does actually provide some interesting examples that help you step through whether or not an agency agreement does actually exist. So this next one, penalties for use of electronic sales suppression tools. The ATO have published a practice statement law administration 2021/D2 for anyone who's interested, that outlines an electronic sales suppression tool, what it is and the penalties that will apply to anyone who uses one. So I actually never really heard of these until recently, but essentially an ESST is a software program or other device that is that is designed to delete or modify sales records so as to conceal sales and income. So clearly the ATO are quite concerned about the rise of these devices, and as a result they're seeking a harsh penalty regime to get ahead of this and prevent people from producing, using or supplying ESSTs. So probably going to hear some more on that in the next little while. Cryptocurrency. So I think lately this has also been something that's been in the news quite a bit, and I'm certainly hearing more and more people that are jumping on board with cryptocurrency investments. So in acknowledgement of this, the ATO has published some new guidance on the taxation of cryptocurrency. In summary, cryptocurrency will generally be categorized as one of three things for the taxpayer. So firstly, it could be held on capital account as an investment. So generally, if you've got it, you've bought some cryptocurrency and you're sitting on it for a while for a longer term gain, then it's more likely to be part of the capital gains tax regime. Option two, you've got it on what we call revenue account, with the holder being an active cryptocurrency miner or trader. And if the activities are sufficient, then the cryptocurrency holder in this scenario may actually be regarded as being in the business of cryptocurrency trading, which essentially means that their cryptocurrency will be taxed at their marginal tax rates and it will be held as trading stock. So the third one, and this is probably a very remote scenario, is that the cryptocurrency may be a personal use asset and principally held for the personal use and enjoyment of the individual. So just a really strong word of warning with that last option. This is going to be a highly unlikely scenario for your average cryptocurrency holder, and it's quite hard to satisfy the classification that the cryptocurrency is actually a personal use asset. This is because virtually all holders will have some kind of profit-making intention, regardless of whether they are holding their cryptocurrency for longer term gain or for short-term trading. And the guidance sets out a series of questions for taxpayers to consider that will help them to figure out which of the three categories they might fit into. Okay, so Pandora Papers, I always think this one's a bit of a fun name. So you've probably also all heard about Pandora Papers in the news, because this is quite a hot topic for a little while there in the news a few months ago. So Pandora Papers was a leak of about 12 million odd documents that revealed hidden wealth and tax avoidance, and in some cases money laundering, by some of the world's wealthiest and most powerful people. And the ATO has announced that they are going to be analysing this data contained in the papers and comparing this to their existing data to determine whether there are any Australian links. And the ATO have said that they are working with 42 national tax administrators to pool their intelligence as part of this exercise. So again, the ATO's data matching powers has just increased exponentially, and there'll be more and more situations, I think, in the coming years, probably more Pandora type papers that come out where the ATO will be able to coordinate with other jurisdictions and really track down whether or not people are reporting their income appropriately. So again, the ATO is encouraging anyone who may be involved in any such schemes to conceal offshore income to get ahead of it and to contact the ATO under their early engagement program. So it's a bit of a get in first, be honest, and they won't be so harsh with the penalties in this case. Okay, so the next one is Ato Side Hustles. So it's just a bit of a reminder here that the ATO are actively looking into the sharing, or some people call it the gig economy, and that the taxpayers who are in this industry need to ensure that they are declaring income from any secondary work that they're undertaking in this sector. So this is probably one that's becoming more and more relevant, particularly off the back of COVID, or I suppose we're still experiencing COVID. And it can include freelancing, setting up at a local market stall, or say income from some kind of subscription platforms. So I think a lot of people, got a bit more creative with trying to find ways to earn income through COVID. So just be aware that the ATO is onto it and they are keeping a lookout on this. Okay, and the last one there on this slide is expanding Australia's tax treaty network. So the Australia has numerous tax treaties with numerous other countries, and they're looking at expanding this and bringing in 10 new and updated treaties by 2023, which I guess we're almost at Christmas time now, so 2023 is not that far away. So that's just a little bit of an update there, and I'm sure we'll hear some more news on that as those come through. Okay, so that's concluded the tax update for this month. There was quite a bit of information in there and quite a few different topics. So if you do have any questions, then please feel free to send those through, or alternatively, you can send me an email. So my email address is hjones@vincents.com.au. I'll just go back to that first slide. So if you did need that email address again, it's available there. Sorry, just all the way back to the beginning. So if anyone did have any questions, send those through now. Otherwise, thank you all for listening and enjoy the rest of your week. So I have got just one question that's come through. So just regarding whether or not the materials will be available for download. So I'll just check with our marketing division after this and confirm for you. But we do sometimes have the materials available for download so that you can have a read through them again afterwards. So I'll just give you guys another minute or so if you've got any other queries. And if anyone was particularly interested in any of the private binding rulings today, then just let us know, so you can reach out to my email address there if you'd like, if you're a little bit shy at the moment, and I can give you those references for those private binding rulings, so you can go and read those in a bit more detail, because I know I did sort of have to rush through a couple of those in a bit of a high-level summary today. Okay, well, it doesn't look like there's any questions coming through, but if you did think of something after the fact, then as I said, please feel free to email me. My email address is hjones@vincents.com.au, and look forward to hearing from you. Thanks, guys. Bye.